Your money is sitting idle late, and losing value every single day. Mutual funds grow your money. Safely perfect this. Watch the full video below. Your financial journey starts right now.
Hello viewers, today we'll be discussing about the mutual funds. Today we'll be unveiling some of the secrets of mutual funds. So in this particular video we will be mainly focusing what is mutual fund, why we need to invest in the mutual fund, in what way mutual funds are better compared to the other investments, at what age we need to invest in the mutual funds, what part of your salary should goes into the mutual funds, and uh, we will also be discussing about who regulates these particular mutual funds. Now first we try to understand what is mutual fund. So mutual fund is nothing but pool of money from many investors, and this particular money is generally invested in stocks, bonds, index funds and other securities. So if you take example of 100 people, so the amount will be collected from these particular 100 people, so that a large corpus will be built, and accordingly this particular corpus will be invested among different investment vehicles. Now example, as I mentioned, 1000 investors are there, and if these 1000 investors are contributing 10,000 each, now there will be a total fund of 1 crore, and this particular fund is generally invested in other investment vehicles, nothing but invested in the stocks or bonds. Suppose in this particular diagram you can see I took an example of some companies like Infosys, TCS, Reliance. I'm not saying that you need to put your money in these particular company mutual fund, just I took an example for your understanding purpose. So the 1 crore which is collected from 1000 investors is invested among these three particular stocks. And why mutual funds? Now normally one of the most common doubt for investor is I can directly purchase in the company shares in the stock market. So why I should purchase mutual funds? So the answer for this particular question is generally you need to prefer mutual funds because it is professionally managed, and you need to prefer mutual funds because it allows diversification. You need to invest in the mutual funds because you can invest in small amounts also. It starts with 500 also, nothing but it is affordable. So it means instead of buying one stock, suppose let us assume that you want to put an amount, if you want to invest an amount of 1 lakh. So instead of investing 1 lakh in one stock, you can purchase 50 stocks. So the answer for your question, why mutual fund vacation, and most important, it is affordable. So as I mentioned, professionally managed. Now what exactly the professionally managed means? Generally mutual funds are managed by the fund managers or nothing but portfolio managers also. They are experts in this particular investments. So these experts manage your investment. The moment when you when you contribute your amount for a mutual fund, your fund is generally managed by the experts. Now these particular experts decides when to buy and when to sell stocks. Next, diversification. So the next and main advantage of this particular mutual fund is diversification, because the amount which is collected from the investors is generally diversified, is nothing but spread across multiple assets. Now let us assume that if 1 lakh is collected from the investors, now this particular 1 lakh will be invested in IT, pharma, banking, insurance, infrastructure, telecommunication. So the fund, instead of putting 1 lakh in one stock, you can diversify this 1 lakh in among the different stocks, so that your risk will be minimized. So that is the reason, the main advantage of mutual fund is diversification. And generally, as I mentioned, who manages? These are managed by the fund managers or AMCs. AMCs are nothing but asset management companies. Example, here you can see HDFC mutual fund, which is generally managed by a expert team. And who regulates this mutual funds? So the mutual funds are regulated by Securities Exchange Board of India, and it is also regulated by AMFI. And what are the different types of mutual funds? So in this particular diagram you can see the major types of mutual funds are equity mutual funds, nothing but equity oriented mutual funds, debt oriented mutual funds, hybrid funds, index funds. So depending upon your goal, depending upon your investment objective, depending upon your investment horizon, you can choose any type of this particular mutual funds. Now if you go with the first one, that is equity fund. Now what is equity oriented mutual funds? So equity oriented mutual funds means your investments are invested in stocks, nothing but your investments are invested in the shares of other company, which gives high return. Suppose example, if you are putting 5,000 rupees as an SIP, if you purchase an equity oriented stock, nothing but equity stock, and if you are contributing 5,000 every month, then this particular amount will be invested in the equity shares of other company, which allows you to create a long-term wealth. And the second type of mutual fund is debt fund. Now this particular debt fund means the amount which is pulled from the investors is invested in the bonds. So normally these debt funds are preferable for the people who are nearing to the retirement, or nothing but the people who already received some corporates after their retirement. So the retired person earning stable income, nothing but this will allow the retired people to earn stable income if you put your money in the debt funds. Now generally debt funds are less risky. Next one is hybrid funds. Now hybrid funds is a combination of equity funds plus debt funds. So example, if you are putting your money, if you choose a hybrid fund and if you want to invest 1 lakh, so 50%, that is 50,000 will be invested in the equity stocks and remaining 50,000 will be invested in the debt stocks. Next one is index funds. So the amount which is collected from the investors, generally the amount will be invested in the index funds, like investing in Nifty. So invest in Nifty index funds. So this is the another type of mutual fund. Then ELSS funds. Now generally this is mainly focused on tax saving. So if you put your money in this particular fund, then you do have a benefit of getting an exemption as per ATC. Liquid funds. Now liquid funds are generally short term only. Now normally if you require if you want to liquidate your investment after the span of 3 months or 4 months, generally you can put your money in the liquid funds which are high liquid in nature. We can also consider these liquid funds as short term funds. Then the most important question, because we just discussed almost 5 to 6 type of funds. So the major question for an investor, there will be a big question mark. The major question for an investor is which fund I need to choose. Whether I need to go with equity, whether I need to go with the debt, whether I need to go with ELSS, whether I need to go with index funds, or whether I need to go with liquid funds. So how to choose? So the answer for this particular question, you need to choose the type of fund on the basis of your investment objective, nothing but your goal. You need to choose on the basis of your risk appetite, and you should also choose on the basis of your investment time. So the type of fund generally chosen on the basis of these particular 3 criteria: goal, risk and time. Example, here there is an example given. Suppose if you want to invest, if your goal is your child education, suppose if a person want to start investing in mutual fund at the age of 25, and if the main purpose of the investment is the child education, then the best suitable type of fund can be the equity fund. Then based on income. So normally how to choose on the basis of income. Normally if a single earner is there, if a single bread earner is there, single income in a family, then it is always suggested to go with a balanced approach. Then balanced approach means it is better for you to go with a hybrid fund. Suppose in income, if dual income is there in a family, then you can go with a growth approach. So it means you may focus on investing in the equity funds. So normally dual income couple invest aggressively. Then if you see the investment rule, so normally how much percentage of your salary should be go into the mutual fund investments? So for this, if you take an example of an individual who is earning 50,000 salary, now normally out of this 30,000 for the expenses, and it means always it is preferred to invest 20 to 40% of your income as investment. Now, age-based investing. So normally if your age is between 20 to 30 years, you should mainly focus on putting your money in equity oriented mutual funds because your risk appetite is high. So you can invest aggressively. And if the age is more than 45 years, it is nothing but you are nearer to the retirement, then always it is preferable to go with a safe approach. So it means if a person starting the investment at the age of 25, then almost 80% of your investment contribution should goes to equity. And the most important thing which you need to understand, it means the cost of delaying the investments. So cost of delaying the investments means the early you start, the better chances are there to grow your corpus. So for your easy understanding, here I took an example. Now there are two individuals, Mr. Rahul and Mr. Varun. Now you can see Mr. Rahul started the investment at the age of 25 and Mr. Varun started investment at the age of 35. So at the age of 25, and these two individuals contributing around 5,000 rupee SIP and they are expecting a return of 10% on their SIP contribution. Now in case of Rahul, because he started investing at the age of 25 and investing an amount of 5,000 per month, here you can see at the age of 60. So it means the investment period is almost 35 years. Started at 25 and at the age of 60, we generally assume 60 as a retirement age. So Rahul is having a investing period of almost 35 years. So because he is having an investing period of 35 years, he is able to create a corpus of 1.9 crores. And if you take example of Mr. Varun, who started investing at the age of 35 and contributing 5,000 per month, and in this case also same, the expected return is 10%. Now in this case of Varun, the investment period is only 35 years he started, and at the age of 60 he is going to retire. So the investment period is 25 years. So if he invests 5,000 rupees per month with an expected return of 10%, and if he invests for a period of 25 years, he is able to generate a corpus of 67 lakhs. So it means there is a 10 years age difference, and the cost of this particular 10 years age difference is 1.2 crores. So this is the cost of delaying your investment. So the common mistakes which you need to avoid before going for an SIP investment, always you need to have a goal. So if you don't have any goal for your investment, it is considered as a very big blunder, and you should not immediately react to the market. There should not be any panic selling. Normally when you heard a news regarding a market crash, immediately you should not respond. So mutual funds is equal to financial freedom. So start investing today. Small SIP, big wealth creation consistently leads to success. So your future depends on today's decision. Thank you very much for watching.
Subscribe to Account Finance with Raavi for finance and accounting insights.